Welcome to the Daily Stock Beaver Market Briefing. Today is July 21, 2026, and we're going to dive straight into the market snapshot. Semiconductor stocks surged more than 5% as dip buyers piled back into AI infrastructure names ahead of big tech earnings this week. Oil climbed past $84 a barrel on escalating Middle East supply disruptions. Bitcoin reclaimed $66,000 on reports of a breakthrough crypto regulatory bill. And the Russell 2000 led all major indices, up 1.5%. Let's break it all down. The story of the day is the semiconductor comeback. After a brutal sell-off late last week that sent chip stocks reeling, buyers returned in force. The semiconductor sector jumped 5.45%, by far the biggest move of the session. Dell Technologies climbed 7% and AMD outperformed on strong data center demand. Investors are positioning ahead of Alphabet and Tesla, both reporting tomorrow, and they're refusing to abandon the AI trade despite questions about Chinese competition and industry pricing power. Meanwhile, the energy story is escalating fast. Oil prices are pressing higher as the US-Iran conflict intensifies and Houthi blockade threats against Saudi Arabia rattle supply chains. The Caspian Pipeline Consortium stopped accepting Kazakh crude after attacks on Black Sea tankers. Goldman Sachs is now mapping a path to $120 Brent. On the crypto front, Bitcoin surged back above $66,000 after the White House reportedly reached agreement on an ethics package tied to the Clarity Act, though analysts warn the market may be getting ahead of itself without Democratic support. We'll dig into gold's rise above $4,000 and silver's 3.5% surge coming up, plus the federal budget picture as the national debt pushes past $39.6 trillion. Now let's rip through the earnings. Charles Schwab delivered a record second quarter, adjusted EPS of $1.62, up 42% year-over-year, on revenue of $7.1 billion. Trading revenue jumped 28% and the firm added 1.4 million new brokerage accounts, though shares slid despite the beat as expenses ticked higher. GE Aerospace posted its fifth straight quarter of 20+% revenue growth, raising full-year guidance on a services backlog now exceeding $210 billion. And United Health Group bounced back with adjusted EPS of $6.38, doubling its buyback authorization to $5 billion and raising full-year EPS guidance to $19.50 to $20.0, though management warned that commercial cost trends remain above 11%. So here's the pattern. Stocks up, oil up, gold up, Bitcoin up, bonds down. This is a risk-on session with a geopolitical hedge layered in. Investors are chasing growth but buying protection against supply shocks and tariff escalation at the same time. Confidence with a side of caution. Here are the numbers. The S&P 500 rose 0.86%. The nasdaq climbed 1.29%. The Dow added 0.74%. And the Russell 2000 led the pack at 1.53%. The VIX Fear Index sits at 17.5, calmer than last week but not complacent. Overall market regime, neutral. Long-term bonds fell, with TLT down 0.27%. The 10-year yield ticked up to 4.6%, the 30-year to 5.11%. The national debt stands at about $39.6 trillion, up roughly $6.4 billion today alone. We'll dive deep into the federal budget later in the podcast. Gold rose 1.66% to $4,082, and silver surged 3.55%. We'll go much deeper on precious metals coming up next. Oil climbed 1.57% to $84.54, and Bitcoin added 1.77% to about $66,000. 11 sectors green, 3 red, but the spread between winners and losers tells the real story. Semiconductors absolutely dominated the board, more than double the next closest sector. Technology followed at 2.46%. That gap between chips and everything else is the AI infrastructure trade in a single snapshot. Investors decided last week's sell-off was a buying opportunity, not a structural break. Energy climbed 1.25%, directly tied to the Middle East supply disruptions we discussed. International stocks ex-US rose 1.66%, benefiting as tariff threats push investors toward non-US exposure. On the losing side, the real surprise is software, down 1.25%, the only tech-adjacent sector in the red. Morgan Stanley downgraded Adobe from equal weight to underweight, slashing its price target from $365 to $240, citing delayed AI monetization. Consumer staples fell 0.84% and communications dropped 0.44%. Classic defensive names losing ground as risk appetite returns. The rotation is unmistakable. Money is flowing out of safety and into growth and cyclicals, with semiconductors and energy absorbing the lion's share. Now let's zoom out and see how the week has shaped up. Week in review. The headline number hides the real story. The S&P 500 slipped just 0.48% on the week, barely a blip. But underneath that calm surface, money was moving decisively. The nasdaq fell 1.3%, its largest weekly drop in over a month, signaling that the AI-led trade that dominated the first half was finally catching its breath. The divergence that matters. The Russell 2000 actually rose 0.76% this week while large caps pulled back. That gap, small caps up, tech down, is the clearest signal yet that investors aren't fleeing risk, they're rotating it. And the year-to-date picture confirms this is a structural shift, not a one-week fluke. The Russell is up 19.1% on the year, double the Dow's 7.9%. Money is broadening out, not leaving. The sector rotation tells you exactly where that money is going. Energy led the week, up 2.86%, fueled by Middle East supply disruptions. Real estate gained 2.0%, and healthcare rose 1.1%. Meanwhile, the sectors getting hit are the ones that led the year. Semiconductors fell 2.68% this week, but they're still up 76% year-to-date. That's not a collapse, that's profit-taking after an extraordinary run. The more telling weakness is software, down 1.9% this week and negative 10.5% year-to-date, the only major sector in the red for both timeframes. The pattern is unmistakable. Investors are trimming the AI trade and rotating into energy and real assets. The cross-asset picture reads like a geopolitical hedge layered on top of risk appetite. Crude oil surged 6.55% on the week, the biggest mover by far, driven by Strait of Hormuz closure fears and Houthi blockade threats on Saudi shipping. The dollar strengthened 0.74% alongside oil, and that combination is the tell. Oil up with a stronger dollar means safe haven demand and inflation fears are feeding each other. Normally, a stronger dollar pressures commodity prices. When both rise together, something unusual is happening. What's notable is what didn't move. Gold barely budged, up just 0.32% on the week and still down 6.93% year-to-date. For a metal that's supposed to be the ultimate crisis hedge, that's surprisingly subdued during an active military conflict. 30-year Treasury bonds fell 0.48% as bond investors demanded higher yields to hold duration against energy-driven inflation. And Bitcoin rallied 4.8% on Clarity Act regulatory optimism, though it remains down 25% year-to-date, a reminder that crypto is still the year's biggest cross-asset laggard. The verdict: this was a week where the market digested its big first-half gains while repositioning for geopolitical risk. The YTD leaders took a breather, energy extended its dominance at plus 28.7% on the year, and the cross-asset signals point to inflation pressure from oil colliding with a resilient stock market. Next week, watch whether big tech earnings can revive the semiconductor trade, or whether energy and small caps keep absorbing the flows. Now let's get into the commodities deep dive, starting with energy and metals. Commodities. The dominant commodities story this year is the energy supply shock. Heating oil futures are up 95.6% year-to-date, nearly doubling. Wholesale gasoline futures have climbed 89.9%. Brent crude sits above $91 a barrel, up over 50% since January. These are wholesale futures prices, not what you see at the pump, but they signal exactly where consumer prices are heading over the coming weeks. The driver is unambiguous. Layered supply disruptions across the Persian Gulf, the Black Sea, and the Red Sea have fractured the global oil supply chain. Wheat futures, up 42% year-to-date, tell you the disruption isn't confined to energy, it's spreading into food. WTI crude is trading at $84.42, up 1.4% today and 6.4% this week. Brent has pushed past $91, up 2.3% on the day. What's striking is the divergence between crude and natural gas. While oil surges on geopolitical risk, natural gas is actually down 0.6% this week and 20% year-to-date at $2.89. The market is telling you the oil spike is about supply disruption, not broad demand strength. If demand were truly booming, you'd see gas rising too. EIA data confirms the physical market is tight. Crude inventories, excluding the Strategic Petroleum Reserve, fell by about 3 million barrels to roughly 316.5 million, a 0.9% weekly draw heading into peak summer driving season. That's the wrong direction for a market already stressed by geopolitical supply risk. Gasoline stocks dropped another 1.5 million barrels to 210.5 million. Refiners are ramping throughput, with net crude input rising about 99,000 barrels per day. They're running hard to meet demand, but inventories keep falling. Natural gas storage built modestly by 41 billion cubic feet, confirming the supply squeeze is real and concentrated in crude and refined products, not natural gas. Our internal positioning analysis reveals something fascinating. Big traders, the hedge funds and CTAs, are net long crude oil, but only at the 11th percentile of their 6-year range. That's a tentative bet, not a crowded one. The real signal comes from the producers. Oil companies are hedging at just the 0.5th percentile, essentially the lightest hedging in 6 years. When the companies that pump the oil are choosing near full exposure to spot prices rather than locking in forward sales, they're telling you they expect higher prices. Meanwhile, gasoline is the most crowded energy trade. Big traders are long at the 93rd percentile. That summer driving season tightness bet is the position most vulnerable if we get any Strait of Hormuz de-escalation. Gold rose 1.8% today to $4,088, but it's down 5.6% year-to-date, a surprisingly weak showing for the classic crisis hedge during active military conflict. Silver surged 3.4% today to $59, but remains down nearly 17% on the year. Platinum and palladium are both down over 20% year-to-date. The precious metals complex isn't attracting the safe haven flows you'd expect. The bright spot is copper, up 2.9% today and 14.7% year-to-date, confirming industrial demand remains intact even as precious metals lag. Our smart money analysis shows professional traders are long gold at the 84th percentile, a meaningful position, though not extreme. Gold producers are barely hedging at the 3rd percentile, confirming the mining industry sees no reason to lock in current prices. But silver tells a very different story. Both long and short positioning sit near historic lows, around the 7th and 8th percentiles. Capital has essentially abandoned silver, concentrating in gold and copper instead. The one metal flagged for risk is palladium, where short positioning sits at 52% of open interest, a crowded bearish bet that could reverse violently on any supply disruption from Russia or South Africa. Wheat futures jumped 8.1% this week to $733, up 42% year-to-date, as Black Sea supply disruptions ripple through global grain markets. That's the number to watch. Wheat is the commodity most directly exposed to the Russia-Ukraine conflict's impact on global food supply. Corn gained 3.2%, and soybeans rose 3.5% this week. These futures moves signal where grocery and feed costs may trend over coming months. Coffee has surged 21% over the past month, another sign that supply stress is broadening beyond energy. The standout in our positioning data is sugar, where big traders are short at the 91st percentile, a crowded bet on bumper Brazilian and Indian crops that could reverse sharply on any weather event. Cocoa long positioning sits at essentially the lowest reading in our dataset. Professional money has completely abandoned the long side. Wheat shorts are actually being covered, with strong positive velocity, even as producers hedge aggressively at the 61st percentile. The industry sees adequate global supply despite the Black Sea headlines. Now let's see how the dollar is holding up against the world's major currencies. Currencies. The dollar has been strengthening against most major currencies this year, and this week it hit a milestone worth paying attention to. The Japanese yen weakened to a 40-year low against the dollar, with the exchange rate climbing above 163, up 4.1% year-to-date. $1 now buys more yen than at any point since 1986. The Bank of Japan remains stuck with ultra-low rates while the rest of the world has hiked, making the yen the funding currency for carry trades worldwide. The euro has weakened 3.1% year-to-date, with hedge funds short at the 98.6th percentile, an extreme bet that the ECB keeps cutting rates. The ECB meets Thursday, and that decision could be a catalyst. The Canadian dollar has weakened 2.9% as Washington's tariff threats rattle North American trade. The one major gaining ground on the dollar is the Australian dollar, up 4.7% year-to-date on commodity exports, which connects directly to the energy story we just covered. Among emerging markets, the Brazilian real stands out, strengthening 7.4% against the dollar this year on commodity exports and high domestic rates. The same energy and agriculture boom lifting futures prices is lifting Brazil's currency. The Chinese yuan has strengthened 3.3%, but the Turkish lira continues its long decline, down 9.8% year-to-date, and the Indian rupee has weakened 7%. Our smart money analysis reveals a fascinating three-way split. Hedge funds are net short the dollar index at 33.6%, betting on mean reversion. But institutional investors like pension funds are heavily long the dollar at 45.5% versus just 4.2% short. Meanwhile, the banks are 52.8% short the dollar at the 78th percentile. When these three groups disagree this sharply, A volatility spike usually follows. The yen, the Canadian dollar, and the dollar index itself are all flagged as moderate reversal risk. The crowd is adding to already extreme positions. For listeners, the stronger dollar means good news if you're traveling to Europe or Japan. Your dollar stretches further than it did in January. The flip side is U.S. exporters face headwinds, and international stock fund returns shrink when converted back to dollars. The bottom line, the dollar's strength is feeding directly into the inflation story by making commodity imports more expensive for everyone else. Treasury and Rates. The yield curve is telling a story of inflation persistence, not recession. The 10-year Treasury sits at 4.6%, the 30-year at 5.11%, and the spread between the 10-year and 2-year is positive at 0.39 percentage points. The curve is normally shaped, not inverted. An inverted curve has preceded every recent recession, and right now it's saying the economy isn't contracting. But the 30-year yield above 5% is the more striking signal. Long-term investors are demanding the highest yield since 2007 to lock up their money. That tells you the bond market sees inflation as a structural problem, not a transitory one. For retirees and near-retirees, this is genuinely the best income environment in roughly 15 years. A 4.6% 10-year Treasury means you can finally earn real income on the safe portion of your nest egg. Money market funds, CDs, and short-term treasuries are paying in the 3.7% to 4.2% range. The catch is that mortgage rates track the 10-year yield, and 4.6% translates to borrowing costs that make home affordability extremely difficult. Yields rose about 5 basis points across the curve in the latest session, a modest move. The signal is in the levels, not the daily noise. FINRA's Treasury trading data showed about $829 billion in volume on July 20, dominated by nominal coupons rather than bills. Dealer customer flow was 45% of total volume, meaning real money clients, pension funds, asset managers, are actively repositioning on the curve, not just banks managing inventory. Heavy client engagement at the long end alongside rising yields tells you institutions are selling duration, not buying it. Our internal positioning data shows hedge funds are heavily short treasuries across the curve. The 10-year has leveraged funds at just 4.9% long versus 37.4% short, the 86th percentile of short positioning, flagged as moderate risk. This is a stagflation bet. Professional money expects yields to keep rising as energy-driven inflation persists while growth slows. On the other side, pension funds are absorbing that duration, 59% long the 5-year and 52% long the 10-year. Banks are carrying shorts at the 94th to 96th percentile across the curve. Any flight to quality surprise forces an explosive short covering rally through that crowded positioning. Stock index positioning adds another layer. Hedge funds are net bearish the S&P 500 at 4.9% long versus 17.4% short. But the VIX reading is the most extreme in our entire dataset. Leveraged funds are long volatility at the 99.8th percentile, the highest reading we've ever recorded, with no prior match in 6 years of data. Professional money is buying crash protection ahead of big tech earnings. Bitcoin carries the highest risk designation in the system at 58.7% short, where any positive regulatory catalyst could force a violent squeeze. Here's the cross-asset picture. Big traders are positioned for escalation across every asset class: long energy, long gold, short bonds, short foreign currencies, long volatility. Physical market participants are either refusing to hedge, like crude producers at the 0.5th percentile, or hedging aggressively only where they see value, like copper producers at the 65th percentile. The risk is binary and asymmetric. Any de-escalation in the US-Iran conflict, any tariff reversal, or any dovish central bank surprise forces simultaneous unwinds across crude, gold, the VIX, and currency shorts. Our stock Beaver positioning analysis as of July 14 shows the most dangerous crowded trades are Bitcoin at 58.7% short, high risk, where any regulatory breakthrough triggers a squeeze. The yen at the 94.6th percentile short, any Bank of Japan hawkish surprise sparks a carry trade unwind. And the VIX at the 99.8th percentile long, the best hedge in the book, or an expensive drag if earnings deliver. The big money is positioned for escalation, but danger is building in the positions most likely to break first. Now that we've seen where rates stand, let's pull back and look at the bigger economic picture, what the Fed is doing, how jobs are holding up, and where the economy goes from here. Economy and the Fed. Let me pull back now and look at the bigger economic picture, what the Fed is doing, how jobs are holding up, and where things stand for everyday investors. The recession clock reads slowdown, with an imminent score of 31.7 out of 100. That score says the leading edge of the economy is softening, but no recession signal has triggered yet. The SOM rule, that early warning jobs trigger, sits at just 0.17 percentage points, a fraction of the 0.50 tripwire. We're not at recession's door, but we're walking toward it. The yield curve has snapped back to normal with a plus 0.74% spread between 10-year and 3-month treasuries. Here's why that matters. When an inverted curve steepens back like this, history says pay attention. It's typically the most imminent recession tell in the toolkit. Building permits are down 2.3% year over year, and cyclical payrolls, the factory and construction jobs that get cut first in a downturn, are barely growing at plus 0.1%. Remember, the GDP and payrolls numbers you hear in headlines only confirm what already happened. They lag by months. The clock is the forecast. This week's data tells a surprisingly resilient story against that cautious clock, and the most dramatic proof is housing starts, which surged 19%. But that's a bounce off a terrible prior month, not a breakout. Initial jobless claims fell to about 208,000, and that's the real signal. When claims drop below 220,000, the labor market is still tight enough to support consumer spending. The Philadelphia Fed Manufacturing Index exploded to 41.4 from 10.3. Readings above 30 in this survey are rare, and signal factories are seeing actual order growth, not just stabilizing. And inflation cooled sharply, with year-over-year CPI dropping from 4.2 to 3.5%. The collective signal is clear. The economy's present-tense numbers are stronger than its leading indicators suggest. That tension between a resilient today and a softening tomorrow is the defining macro story. Housing starts came in at an annualized 1.43 million units, surging 19% from May's week reading of 1.2 million. But here's the catch: building permits, which lead starts by a few months, fell 3% to 1.37 million. That divergence is the story. Builders are catching up on last month's lost ground, but the forward pipeline is thinning. With mortgage rates still above 6.5%, the affordability wall hasn't moved. That starts number is a dead cat bounce off a bad base, not a breakout. Financial conditions eased further this week. The Chicago Fed's National Financial Conditions Index sits at minus 0.54, deeply loose territory where credit flows freely. That means money is still cheap and available, not the environment where recessions typically take hold. But one yellow light is flashing. The leverage subcomponent sits in positive territory at plus 0.33. That's the one area where conditions are actually tightening, and it connects directly to the margin debt picture we'll hit at the end of this segment. When leverage is the stress point while everything else is calm, it tells you the system's vulnerability isn't credit access, it's investor positioning. The labor market's freshest read is solid on the surface. Initial jobless claims for the week ending July 11 fell to about 208,000, down from the late June peak of 230,000. That 22,000 drop tells you companies aren't swinging the layoff axe. June's unemployment rate ticked down to 4.2%, and the underemployment rate fell to 7.9%. But the more revealing signal is in the duration breakdown. The number of people jobless for 15 weeks or longer dropped 8% month over month. When long-term unemployment starts falling, it means hiring is picking up enough to absorb the people who have been stuck, not just the freshly laid off. The shadow here is labor force participation, which slipped to 61.5%. Fewer people actively looking for work means the talent pool is shrinking, which is a structural drag on future growth even if today's headline looks fine. The 30-year fixed mortgage sits at 6.55%, up from 6.49 a week ago. A year ago it was about 6.23, so the trend is the wrong direction. For anyone sitting on a 3% mortgage from 2021, the payment on a new loan at 6.55% is roughly 60% higher for the same principal. That lock-in effect is freezing the housing market in place. Nobody sells, nobody moves, inventory stays tight. For retirees with paid-off homes, this is academic. For anyone still carrying a mortgage or helping family buy, it's a real wall. The VIX sits at 18.65, up about 9% on the week but still in normal territory. Healthy caution, not panic. But underneath the headline calm, the cracks are specific. The nasdaq Volatility Index is elevated at 28.5. Tech investors are notably more nervous than the broad market, and that tells you where the real earnings risk lives. The crude oil VIX is at 62, reflecting extreme uncertainty about Middle East supply. That's a geopolitical risk premium baked into energy costs. The headline number says calm. The components say nerves are concentrated exactly where AI earnings risk and geopolitical risk collide. The Fed's balance sheet held flat at about $6.74 trillion as of July 15. Quantitative tightening is effectively paused. The Fed is letting the balance sheet drift rather than actively shrinking it. The reverse repo facility is down to essentially zero, about $0.3 billion. That matters because the reverse repo was the excess liquidity cushion from the easy money years, and it's nearly depleted. When that cushion is gone, the Fed has less room to maneuver if markets seize up. Mortgage-backed securities on the Fed's books are slowly rolling off, down to about $1.95 trillion, and every bit that runs off puts gentle upward pressure on the same mortgage rates we just discussed. The Fed is in a holding pattern, watching the data, but the plumbing that supported markets is thinner than it looks. The week's biggest economic surprise was inflation. Headline CPI year-over-year dropped to 3.5% for June, down from 4.2% in May and well below the 3.8% consensus. That's not just a beat, that's a full percentage point of cooling in a single month. Core CPI was flat month-over-month, 0% when Wall Street expected 0.2. And here's the forward-looking signal. Producer prices actually fell 0.3%. Producer prices lead consumer prices by about a month, so that drop points to further cooling ahead. The bond market's 10-year break-even inflation rate sits at 2.25%, essentially at the Fed's target. Markets are saying inflation is done as a threat. But the 10-year real yield is 2.35%, and that's historically restrictive territory. Inflation-adjusted borrowing costs are still high enough to break the economy, which is exactly the tension the Fed faces. Inflation is cooling, but policy is still tight. Retail sales for June rose 0.2%, right at expectations. But strip out autos and sales actually fell 0.2%. That gap is the story. The consumer is spending, but it's being dragged by auto sales, not broad-based demand. Momentum is fading from May's 1% surge. The Atlanta Fed's GDP Now tracker puts second quarter growth at 1.7%, modest but positive. Michigan consumer sentiment jumped to 54.4 from 49.5, with one-year inflation expectations dropping to 4.2% from 4.6. Consumers feel a bit better about prices, but the ex-autos spending number says they're not opening their wallets like the sentiment survey suggests. The vibe and the wallet are pointing in different directions. The May trade deficit widened sharply to about $77.6 billion, up 42% from the prior month. The goods-only deficit was even larger at roughly $106 billion, missing estimates by about $21 billion. Here's the mechanism. A strong dollar makes imports cheaper and exports more expensive, widening the gap. Layer tariff escalation on top, and this deficit becomes a structural headwind for growth. Every dollar of imports that replaces domestic production subtracts from GDP. The data is about 80 days old, but the direction is unmistakable. Finally, a standing read on investor leverage. FINRA's margin debt figures show about $1.5 trillion borrowed against brokerage accounts as of June, up 6% month-over-month, and up a striking 49% year-over-year. That year-over-year rate above 30% has historically preceded major market tops, not because it's a timing signal, but because it means leverage has built up to the point where any shock gets amplified. The net credit balance is deeply negative at minus $1.6 trillion. That means investors collectively have borrowed well past their cash buffers. They're flying without a cushion. Paired with the tightening leverage signal in financial conditions we saw earlier, this is the kind of positioning that turns a routine pullback into something worse. So where does the week leave us? The clock says slowdown, and the leading indicators, permits, participation, cyclical hiring, all confirm it. But this week's fresh data showed surprising resilience. Housing bouncing, claims falling, inflation cooling faster than expected. The economy is in that awkward phase where the headlines look fine but the foundation is shifting beneath them. Whether corporate earnings validate that resilience or expose the cracks is exactly what we'll dig into next. Earnings pulse. 3 sectors made the cut this week. Energy leads as the top weekly mover, one of one beat on earnings, guidance maintained, tone bullish. Financial services is the heaviest reporting sector with 23 calls in the last 14 days, 5 of 6 beat earnings, 4 raised guidance, tone bullish across the board. And communication services, the week's worst performer down nearly 2%, delivered 1 beat with maintained guidance and a bullish tone. Let's break them down. Energy's pricing power story in 2026 is ultimately a story about scarcity, of turbines, of pipeline capacity, of refining complexity, of export terminals. And the companies that own scarce assets are extracting economic rents. The market has only begun to properly price. Halliburton, ticker HAL, gave us the sector's only red this morning. The oilfield services giant posted earnings of $0.55 per share, beating the estimate of about $0.54, and revenue of $5.7 billion, topping expectations near $5.5 billion. Shannon Slocum, a senior completion and production executive, put it bluntly, pricing is improving and the playbook works. Management's tone was bullish, guidance maintained. The pricing signal is genuine. Halliburton's international revenue hit $3.4 billion, up 6% year-over-year and the strongest Q2 international result in over a decade. Europe and Africa surged 19% sequentially. The company landed major contracts across Iraq, Algeria, Argentina, and Suriname. In North America, management added more than 30 rigs and said there is zero available electric frac capacity. When your equipment is sold out, you set the price. Yet shares fell about 5.5% since the call. The issue is near-term. Third-quarter completion and production revenue guided flat to down 2%, with margins at the lower end of the range due to maintenance costs and Gulf of Mexico delays. Management framed this as product mix and seasonality, not structural weakness, and pointed to expected margin improvement of 125 to 175 basis points in Q3. But investors wanted proof today, not promises for next quarter. The deeper read for retirement portfolios. Halliburton is deliberately redeploying equipment from North America to higher-margin international markets, Argentina, Saudi Arabia, the UAE. That is scarcity economics in action. The company's CEO affirmed 30 to 35% incremental margin expectations and hinted at potential upside. The thesis isn't broken, it's just taking longer than the market wanted. Across financial services, the unifying signal is unmistakable. Pricing power is consolidating into entities that either own irreplaceable infrastructure, embed themselves irreversibly in customer workflows, or operate at a structural cost advantage that turns competitive pricing into a weapon. Everyone else is growing volume and hoping nobody notices the margin trajectory. 6 major calls came in here, all bullish. Yet the market's reactions ranged from plus 0.8% to minus 10%. That spread is the story. Charles Schwab, ticker SCHW, delivered record-adjusted earnings of $1.62 per share, up 42% year-over-year, on revenue of $7.1 billion. Schwab added 1.4 million new brokerage accounts and pulled in $120 billion in net new assets in a single quarter. Management raised full-year revenue growth guidance to 17.5 to 18.5% and projected 800 basis points of operating leverage. When your cost to serve is the lowest in the industry and you're executing one-third of all retail brokerage trades, scale becomes a pricing weapon. Contrast that with MSCI, ticker MSCI. The index and analytics provider missed earnings at $4.94 per share versus the $4.99 estimate and came up short on revenue too. CEO Henry Fernandez was emphatic. The firm sees a big trajectory and is prepared to buy back its own stock. Management even raised guidance, pointing to hedge fund subscription growth accelerating to 15%. But the market punished the contradiction. You can't miss on both lines, raise spending, and expect applause. Shares fell about 10% since the call. In between those polls, KeyCorp raised full-year guidance with investment banking pipelines up 31% year-over-year. Synchrony Financial lifted its EPS target to $9.25 to $9.50 as its Walmart partnership became the fastest-growing program in company history. And W.R. Berkley, ticker WRB, was the only name with a positive reaction, up about 0.8%, with management saying the business is firing on all cylinders and they see nothing in the way of outstanding returns. 4 of 6 raised guidance, 0 cuts, all bullish. But in a uniformly optimistic sector, the market is ruthlessly separating genuine operating leverage from hopeful narrative. Communication services is the week's worst-performing sector, down nearly 2% and negative on the year. The pricing power verdict here is a reinvention of the playbook. The strongest form of pricing leverage is giving customers more for the same price rather than charging more for the same product. Netflix, ticker NFLX, gave the sector's only read on July 16. Earnings came in at $0.80 per share, a beat. Revenue narrowly missed at about $12.6 billion. Shares dropped roughly 6.8% since, yet management's tone was measured but confident. The company reaches about 330 million subscription households, still under 45% penetration of an estimated 800 million addressable households worldwide. And here's the pricing kicker. Netflix subscribers pay the least per hour of viewing compared to comparable streaming services. In some cases, they'd have to pay twice as much elsewhere. That gap is latent pricing power. Netflix raised prices in the US, Mexico, and Spain during the first half of the year, and those increases performed exactly in line with prior cycles. No change in customer receptivity. The ad-supported tier's revenue gap versus ad-free is narrowing, which management called near-term under-realized growth. The trade-off is that content spending is projected up about 10% in 2026, and AI-driven production savings are being reinvested into more content rather than flowing to margins. Full-year revenue guidance holds at 13 to 14% growth. Netflix has pricing power, knows it, and is choosing to reinvest rather than harvest, a luxury only a deeply entrenched platform can afford. The company did repurchase a record $4.7 billion in shares during the quarter, with about $27 billion remaining on authorization, which is a signal that management sees value even if the market is hesitating. The through-line across all three sectors is pricing power, but it's narrowing to companies with scarce physical assets, embedded infrastructure, or irreplaceable customer relationships. Every company this week was bullish. Not one cut guidance. Earnings quality is strong. The market is just getting more selective about what it'll pay for. Now let's see how this lands on our top stock and ETF picks. Market technicals. Since January, energy stocks have been the runaway leader, up 28% year to date, with your tech funds close behind at about 25%. But here is the surprise. Tech's momentum gauge, what traders call RSI on a 100-point scale, sits at just 42. That is actually cool, not hot. Tech led the year but has been catching its breath lately. Meanwhile, only about 55% of the names in this market are trading above their 50-day trend line. Think of that as a health check, and barely half the market is in an uptrend. That is thin breadth for a market still up nearly 10% on the S&P 500. The rally is real, but it is not particularly wide. The market is rewarding risk, not hiding in safety. The leaders over the past 3 months are tech, small caps, and healthcare. The laggards are long-term bonds, utilities, and consumer discretionary names. When safe haven bonds and defensive sectors are the ones being sold while growth and smaller companies attract money, that tells you investors are comfortable reaching for returns. One flag worth noting. Technology is running about 12% above its longer-term trend line. That is the most stretched name on the board. It has been a powerful run, but it is the spot most likely to pause if any disappointing earnings land this week. Financials are the most overcooked sector right now, with a momentum score of 0.71 on a scale from -1 to +1, and an RSI of 65. Your bank stocks have been running hard. On the flip side, materials, consumer discretionary, and communications are the most beaten down, all scoring in negative territory. But here is the quiet rotation. Healthcare and real estate are sitting in the sweet spot. They have solid momentum scores and positive returns over the past 3 months, but they are not yet overheated. That is where money is finding a middle ground between chasing what is hot and bottom fishing what is cold. Value investing is back in favor. Deep value and plain value funds sit in the upper right zone, meaning they have both positive absolute momentum and are beating the broader market. Momentum funds are right there with them. On the opposite side, gold and long-term bonds are in the washed-out lower left corner, out of favor and struggling. Growth funds are interesting. Their absolute trend is still positive, but they are lagging the market on a relative basis. One style worth noting is emerging markets, sitting essentially at the zero line on absolute momentum. That is the earliest hint that international stocks might be starting to rotate back into favor after being left behind. The overall market health score reads about 73 out of 100, which puts it in the extended zone. Think of this like a thermostat. The market is running warm, not dangerously hot, but warmer than its own historical average. That generally agrees with the price trend, but it also means there is less margin for error. A warm market can keep climbing, but it tends to react more sharply to bad news. Big money is still flowing into stocks, not out. Our internal money flow reading, which tracks the balance of buying versus selling pressure across weekly dollar volume, sits at 62 in what we call the accumulation zone. Institutional volume is leaning toward adding positions rather than trimming them. That agrees with the price trend, which gives the rally more credibility than if we saw prices rising on thin participation. The stock Beaver sentiment composite reads 59 out of 100, which we label neutral. The crowd is neither greedy nor fearful. What is propping it up is low volatility, with the VIX fear index sitting at about 19 and decent momentum. The pillar pulling hardest in the other direction is the RSI, that price strength gauge, which at 48 says the market's recent push has lost some steam. Importantly, sentiment has cooled from where it was a year ago, when it sat above 80. The crowd is less enthusiastic than last summer, and that is actually a healthier backdrop for a market to keep climbing without the kind of euphoria that typically precedes pullbacks. If there is one thing to watch this week, whether tech earnings can reignite the momentum that has cooled, or whether money keeps rotating toward value and small caps instead. Top stock picks. Our buy signal radar is lighting up with fresh signals. 6 stocks triggered new buy signals as of yesterday's close, and 4 of them carry what we call high confluence. They're not just on a mechanical buy signal, they're also ranking among our strongest momentum names. That double confirmation is what we want to see before putting fresh capital to work. The Travelers Companies, ticker TRV, fired a buy signal at $368.50, and it's also one of our top momentum stocks. Cintas, ticker CTAS, at $201.80, same story. Global Payments, ticker GPN, at $82.37, and PayPal, ticker PYPL, at $56.82, round out the high confluence group. 2 additional names, Ross Stores and Abbott Laboratories, also flashed by signals. Abbott is especially notable. The company raised its full-year adjusted earnings guidance on July 16th after a solid second quarter, returning $2.1 billion to shareholders through dividends and buybacks. That kind of capital return paired with a fresh buy signal is exactly what income-focused investors want to see. Now let's dig into what's hot right now, the stocks surging over the past week. PayPal leads the entire momentum board with a 17.9% gain over 7 days and a striking 31.9% over the past month. The catalyst is tangible. Reports surface that Stripe and Advent International are pursuing a buyout of PayPal at roughly the company's current market value. One analyst at Clear Street is keeping a hold rating, calling the company a strategic crossroads. But 17.9% in a week tells you the market sees something shifting. The Travelers Companies is up 9.7% this week and 19% over the past month, trading near $370. The property and casualty insurance sector is transitioning after a 7-year hard market of aggressive rate hikes. Pricing is beginning to soften, but Travelers is demonstrating the kind of underwriting discipline that matters when the cycle turns. Josh Brown of Ritholtz Wealth Management just named Travelers one of his top dividend stocks for 2026, alongside Chubb and Aflac. For retirees listening, that dividend angle is meaningful, and the earnings pulse confirmed financial services as a sector bright spot this quarter, with 5 of 6 firms beating estimates across the board. 3M Company, ticker MMM, surged 9.1% this week to about $171. The narrative here is an industrial turnaround story. 3M is scaling its expanded beam optical technology through a Microsoft partnership, targeting the data center and fiber optics boom. The stock has been choppy over longer timeframes, but this week's action suggests investors are warming to the strategy and the company's improving operational execution. Coinbase, ticker Coin, jumped 8.9% this week as the crypto exchange pushes its everything exchange vision, unifying spot trading, derivatives, staking, and on-chain settlement into one global platform. Some investment firms are suggesting the crypto market may be nearing a bottom, but keep perspective. Coinbase is still down roughly 57% over the past year, so this is a recovery play, not a steady uptrend. Position sizing matters with names like this. Cintas, ticker CTAS, rounds out the hot list at 8.7% this week and 18.3% over the past month. The uniform and business services company was flagged as a top consumer discretionary pick as consumer sentiment hit a 5-month high with falling energy costs. That's a clean, accelerating trend, the kind that tends to draw in institutional money as confidence builds. Several recovery stories deserve attention. Adobe, ticker ADBE, was actually downgraded by Morgan Stanley today from equal weight to underweight, with the bank cutting its target by more than a third, from $365 to $240. The concern centers on multiple strategic transitions unfolding simultaneously. Despite that headline, the stock is up 2.9% this week as dip buyers step in, a reminder that analyst calls don't always dictate short-term direction. LyondellBasell, ticker LYB, is up 4.5% this week and 37.8% year-to-date, near $61. The chemicals company is benefiting from Middle East supply disruptions tied to the Iran conflict, which have tightened global chemical supply. Analysts see Q2 earnings surging, with U.S.-based production and access to cheap natural gas giving LyondellBasell a meaningful cost advantage over international competitors. Prologis, ticker PLD, is worth watching on the M&A front. The warehouse giant faces a Wednesday deadline to either bid for UK warehouse landlord Segro or walk away. Norway's sovereign wealth fund, holding stakes in both companies, is publicly urging constructive talks. That deal dynamic adds an interesting layer to an already solid 18.4% 6-month return for Prologis. Now for the big picture, the strongest 6-month trends in the market. And the story here is energy, pure and simple. Marathon Petroleum, ticker MPC, has delivered an 81.9% return over 6 months and 93.6% year-to-date, trading near $320. Valero Energy, ticker VLO, is up 68.4% over 6 months and 90.4% year-to-date at about $315. Phillips 66, ticker PSX, has gained 49.6% over 6 months. These three refiners dominate the leaderboard. The thesis comes down to scarcity of refining capacity, of export infrastructure, of pipeline access. The earnings pulse confirmed this energy tailwind when Halliburton beat estimates this season, noting that pricing power is improving across the entire complex. What's striking about Marathon and Valero specifically is how steady these climbs have been. Both are exceptionally smooth, persistent trends, not spike-in crash patterns. For investors who remember the whipsaw of energy stocks in past cycles, that level of stability stands out. The confluence here is powerful. Travelers appears not just on the Hot This Week list with a 9.7% gain, but also among the best 6-month performers at 32.7%. And the refining trio shows up on both the year-to-date and 6-month leader lists. When a stock leads across every timeframe, that's a structural tailwind, not luck. APA Corporation, ticker APA, deserves a mention too, up 40% over 6 months and 41% year-to-date near $36. The energy producer has been a quieter winner, but the trend is unmistakable and accelerating. Ventas, ticker VTR, might fly under the radar, but it shouldn't. Up 27.5% over 6 months and nearly 47% over the past year near $98. This healthcare REIT benefits from demographic tailwinds as the aging population drives demand for senior living and healthcare facilities. For income-focused listeners, that combination of price appreciation and the REIT structure's required dividend distributions is exactly the kind of total return story that compounds a retirement portfolio over time. A quick smart money note to close. Across our picks today, shorts are mostly behaving. No extreme builds or covers that would signal bears are aggressively fading these moves. That's actually a quiet positive. When bullish momentum isn't met with heavy short selling, it suggests the broader market consensus is leaning the same direction. No squeeze dynamics to flag today, but that clean backdrop is precisely the environment where trends can persist rather than reverse violently. Top ETF picks. The leveraged ETF buy signal radar is flashing one overwhelming theme right now: energy. We're tracking more than 50 leveraged ETFs currently on active buy signals, and energy funds dominate the list. Every signal triggered fresh yesterday, July 20th, so these are all day one of new uptrends. The highest conviction setups are the ones appearing on multiple lists simultaneously. NRGU, the microsector's Big Oil 3X Fund, Gush, the Direction Oil and Gas Exploration Bull Fund, and ERX, the Direction Energy Bull 2X, are all flashing by signals while simultaneously ranking on the momentum leaderboard. That cross-confirmation between technical signal and actual price strength is exactly what you want to see before deploying capital. Now, the mandatory reality check. Leveraged ETFs use derivatives to amplify returns and losses. They're for short-term trading only and decay if held long-term due to daily rebalancing. Keep positions small and have an exit plan. These are short-term trading vehicles, not something to buy and hold in a retirement account or with money you're counting on. The story this week is oil, plain and simple. Middle East shipping disruptions are front and center. Reuters reported the Houthis escalated threats against Saudi oil shipments, and Goldman Sachs now sees a path to $120 Brent crude. Meanwhile, the International Energy Agency said its members have released roughly 290 million barrels from reserves since March. Supply is tight, and markets are pricing it. That's why WTIU, the microsector's Energy 3X fund trading around $18.35, surged 14.8% this week, and is up 83.5% year-to-date. NRGU is right alongside it at $43.37, up 13.1% over 7 days, and an extraordinary 133.5% on the year. When a fund tops both the weekly and yearly leaderboards at the same time, that's not a flash in the pan. It's sustained, accelerating momentum. And the energy earnings pulse confirms the bid. Halliburton just beat on both earnings and revenue this week, reinforcing the sector's pricing power story. Gush, at $38.74, is up 9.7% this week and nearly 70% year-to-date. UCO, the ProShares Ultra Crude Oil Fund at $42.7, gained 7% this week and sits at 118% year-to-date. ERX, the Broad Energy Bull Fund at $91.86, is up 5.5% over 7 days and 58% on the year. DIG rounds out the group with a 5.8% weekly gain and a strong, accelerating trend. Stepping away from oil, there's a quiet but forceful bid in leveraged Apple funds. AAPB, AAPX, and AAPU, three separate funds all tracking Apple at 2x leverage, priced between $40 and $44, are each up around 8% this week and roughly 20% over the past month. The trend is strong across all three, though direction is decelerating slightly, which tells you the initial burst may be cooling even as the broader uptrend holds. Among recovery plays, ADBG, the leveraged Adobe fund, has surged nearly 34% over the past month on a strong, steady trend from deeply oversold levels. CRMG, the leveraged Salesforce fund, is up 25% over 30 days with the same steady recovery profile. Both are showing real signs of life after steep drawdowns. On the leveraged technical leaderboard, XOMX, the direction daily ExxonMobil Bull 2X at $42.31 carries a standout profile with a bullish MACD crossover, a golden cross, and controlled momentum. It's up 9% this week. OILU, the Oil and Gas Exploration 3X fund at $42.50, shows the same technical confluence and is up 7.7% over 7 days with nearly 74% year-to-date gains. For something entirely outside energy, IWDL, the ETRACS2X leveraged U.S. value factor fund at $64.77, is quietly building a solid uptrend, up 39% year-to-date with a golden cross and steady acceleration. Turning to smart money positioning, FINRA's latest red show snapshot from July 20th shows UJB and ORLG both sitting at or near 100% short volume as a share of daily trading, with FB and SUPL close behind at roughly 99.5%. Now, the important context: most short volume in leveraged ETFs is simply intraday market maker plumbing. Dealers short shares to facilitate customer orders and cover minutes later. The real signal lives in the extremes and in whether any names overlap with our picks. And a reminder that heavy shorting of an inverse or bear ETF is effectively a bullish bet on the underlying. When traders short a semiconductor bear fund, they're expressing optimism on chip stocks. Drilling into the leveraged ETF specifically tied to today's picks, hedger activity is broadly normal. No major shorting spike or short covering signal jumps out this week. That's actually a clean read. It means the energy momentum we're tracking isn't being met with aggressive institutional pushback. When big money isn't leaning against a trend, that's either a quiet vote of confidence or, at minimum, an absence of resistance. The technicals stand on their own merits, and the smart money flow isn't contradicting the bull case we just laid out. Options activity and setups. Now let's flip to the options market. First, what the broader tape is telling us about fear and dealer positioning. Then we'll bring that read back down to the individual stocks on today's pick list. Traders bought more puts than calls today. The aggregate put-call ratio across the major index ETF sits at about 1.3, meaning roughly 1.3 puts traded for every call. A ratio above 1 tells you bearish bets outnumbered bullish ones, which is a cautious read. The most nervous tape is in the QQQs, where that ratio climbed to 1.42. Small caps in IWM were more measured at 1.16, but all three indices agree: more puts than calls, more hedging than speculation. But here's the twist. The 25 delta skew on the SPY, think of that as the cost of out-of-the-money put insurance versus out-of-the-money call lottery tickets, sits at just 4.73 points. That's a low fear reading. Crash insurance is surprisingly cheap right now, almost the same cost as upside lottery tickets. So the put-call ratio says cautious, but skew says calm. Mixed signals. Traders are buying downside protection in size, but they're not paying up for it, which suggests routine hedging, not bracing for a crash. Now to the market makers, the dealers who sell us most of these options. Their hedging either calms the tape or amplifies it, and today the message is loud. All three major indices are in amplifier mode. Gamma exposure, or GEX, measures which way dealers are forced to trade as price moves. When GEX is negative, what we call short gamma, dealers act like an amplifier, selling into weakness and buying into strength. Moves get supercharged. SPY is sitting at about $748 with a gamma flip price of $765. That flip is the level where dealer behavior switches from shock absorber to amplifier. Right now SPY is trading roughly 17 points below it, squarely in the amplifier zone. Same story in the QQQs, spot at $709, flip at $743, about 34 points below. And IWM is below its flip too, at $282 versus $287. Dealers are short gamma across large caps, tech, and small caps alike. Expect sharper, faster swings if the tape starts moving. One anchor to watch. SPY max pain sits right around $745, very close to where we are, that can act like a magnet as expiration approaches. Shifting to sector volatility. Implied volatility is the market's forecast of how wild a stock will swing. Realized volatility is how wild it actually has been. When implied runs well above realized, options are pricing in more drama than reality. The software sector, tracked through IGV, is the richest on the board. Implied vol there is running at about 39% against realized of just 26%, a ratio of 1.52. Options are priced as if software stocks will move roughly 50% more than they actually have. That kind of premium usually shows up before earnings or a major catalyst. On the flip side, semiconductors via SOXX are actually cheap, implied vol of about 65% against realized of nearly 72%. A ratio below 1 means option sellers can't command much premium because the sector has been moving more than the options imply. After yesterday's sharp chip stock rebound, traders seem to be pricing in calmer waters ahead, either complacency or confidence that the worst of the scare is behind us. One name stands out with genuine cross-segment confirmation. Robinhood, ticker HOOD, heavy call activity showed up on our options scanner, and it also appears in our insider activity segment. That's the kind of confluence we look for. About 60% of its standing open interest changed hands today with a put-call ratio of 0.37, meaning roughly 3 calls for every put. When insider buying and options flow point the same direction, that's worth noting. The biggest pure options flow is in Oracle, ticker ORCL. Volume exploded to about 85,000 contracts, nearly 10 times the next busiest name. The put-call ratio was an extraordinary 0.9, meaning roughly 11 calls traded for every put. That's about as one-sided bullish as options flow gets, but no confluence today, it stands alone. On the bearish side, IWM saw a put-call ratio of 2.37, more than 2 puts for every call. Someone is either hedging small cap, exposure aggressively, or positioning for a pullback. For anyone running a covered call strategy, where you own shares and sell call options against them to collect premium income, a few names stand out. Western Digital, ticker WDC, shows implied volatility of about 114% with an IV rank of 82. That rank tells you the stock's option premiums are elevated compared to their own history. You're selling volatility when it's temporarily rich, not when it's permanently high. The 15% out of the money call is pricing roughly 89% annualized. Seagate, STX, is similar at 109% implied vol with a rank of 94, pricing about 84% annualized. But an honest caveat, these are high beta storage and chip names. The premium is rich because these stocks genuinely move that much. A covered call caps your upside on exactly the rally that would bail you out of a drawdown. Size accordingly. Now let me bring that backdrop down to our picks. Where in today's stock list does options positioning also argue for higher prices? The honest answer, nowhere. We pre-filtered the pick list and 0 names qualified, none passed the strict gamma squeeze checklist, and none carried a clear bullish positioning bias. The scorecard shows only picks where options activity leans bullish. Today it's empty. We evaluated 10 confluent tickers, and every single one either failed the 4-part gamma squeeze test or had neutral to bearish positioning. That's not a red flag fundamentally. It means the options market isn't providing a structural tailwind under any of them right now. The wind isn't at their back from the derivative side, but it isn't in their face either. For context on what we screen for, a real gamma squeeze setup needs 4 things at once: spot below the gamma flip so the amplifier is on, gamma exposure actually negative, a call wall 3 to 15% above for runway, and a put wall in the same zone for a floor. None of today's picks cleared that bar. The secondary bucket, names that don't pass the strict checklist but still show bullish dealer positioning, also came up empty. That happens. Some sessions the tape lines up perfectly with our pick list. Today it doesn't. With no qualifying candidates, there are no price level maps to walk through. What I will note is this: the broader dealer positioning we covered earlier, all 3 indices in amplifier mode, means if any of these picks do catch a bid, the move could be sharper than usual. The machinery is switched on at the index level. It just hasn't aligned at the individual stock level for our watch list. The positioning card is empty as well. No mechanics to dig into, no analogies to teach. When the gamma squeeze screen comes up dry, it often pays to wait. These windows open and close. Sometimes a name slides into position a day later as dealers re-hedge and strikes roll off. The screen runs fresh every session. Remember, this whole segment is positioning context, not a trade idea. A picks list with a gamma tailwind underneath is a higher quality setup than one without. That's the only claim. Today the tailwind isn't there on individual names, even though the index level amplifier is on. With that backdrop locked in, let's see what Congress was doing this week. Congressional Trading. Fresh filings hit the tape today, and the most active discloser is Representative Dan Newhouse, who who filed a sweeping portfolio reshuffle on July 20th covering transactions from July 10th. Newhouse sold 9 positions, including United Health UNH, NVIDIA NVDA, Eli Lilly LLY, Intuit INTU and Palo Alto Networks PANW, while buying Uber UBER, Micron MU and Morgan Stanley MS. Meanwhile, Representative James Hims disclosed 3 sales today from yesterday: ExxonMobil, XOM, and Home Depot HD, each in the $15,001 to $50,000 range, plus a smaller Bank of America, BAC, sale. The week's cluster activity tells a clearer story. 3 separate House members, Newhouse, Debbie Dingell and Kevin Hern, all sold HONA this week, totaling 4 sells. Alphabet GOOGL drew the same pattern. Newhouse, Dan Crenshaw and Thomas Keene all unloaded shares. When multiple members independently exit the same name, it is worth a closer look. ExxonMobil and Bank of America each saw coordinated selling from 2 members as well. Stepping back to the 30-day picture, the 2 chambers are pulling in opposite directions. The Senate traded just 39 times, 14 buys against 23 sells net selling. The House, by contrast, logged 359 trades with 198 buys against 161 sells, leaning net bullish. House members accumulated S&P Global SPGI, Hubble HUBB, Danaher DHR, and Mercado Libre MELI most aggressively. On the sell side, GOOGL and Westinghouse Airbrake WAB topped the list. That Senate-House divergence is notable. One chamber is trimming, the other is adding risk. Insider activity. 2 insiders at Elevance Health, ticker ELV, bought shares this week. Chairman Ramiro Peru and Director Gail Boudreaux combined for roughly $1.37 million in purchases. Peru's buy alone increased his direct equity position by about 10%. When the chairman of a major health insurer is putting personal capital to work alongside another board member, that's a coordinated vote of confidence worth noticing. The broader insider backdrop, though, is firmly tilted towards selling. Over the past 14 days, Beaver's internal analysis shows just 14 open market buys against 945 sells, a buy-to-sell ratio of 0.1. Most of that selling is routine: tax planning, diversification, pre-planned transactions. The largest came from Rocket Lab at about $286 million and Dell at roughly $221 million. But the lopsided ratio confirms insiders are generally harvesting gains, not adding. The most striking signals sit outside the major indices. Sumitomo Mitsui Financial Group poured roughly $318.7 million into Jefferies Financial Group, ticker JEF, by far the largest single insider purchase this period, and a strategic bet from a major global bank. Separately, Prudential Financial committed about $60 million to ticker TYG. These aren't token purchases. When an institution deploys hundreds of millions into a single name, it reflects conviction grounded in information the rest of us simply don't have. Cluster buying and mega purchases are the market's closest thing to a genuine tell. Federal budget. Through July 20th, the federal government collected about $241 billion in net receipts against $452 billion in spending, a deficit of roughly $211 billion. That's about $6 billion wider than the same point last July, which signals that even in a strong economy with rising tax revenue, spending is still outpacing collections month over month. Gross receipts came in at $249 billion, but nearly $8 billion went straight back out as tax refunds. A reminder that headline collection numbers overstate what's actually available to fund operations. On the spending side, Health and Human Services led at $156 billion, followed by Social Security at $98 billion. But here's what should grab you. Interest on Treasury securities is now climbing past defense, which sat at $44 billion this month. Mandatory health and retirement spending plus interest costs are consuming the budget, leaving less and less room for discretionary priorities. And on a single day, Customs and Border Protection deployed $2.3 billion, a glimpse of how border operations have become a significant line item in their own right. Zoom out to the full fiscal year, and the structural story comes into focus. Through July 20th, the government has collected about $4.7 trillion and spent roughly $5.94 trillion, for a cumulative deficit of $1.24 trillion. That's actually a 7% improvement versus the same point last year, but it's improvement in the way a patient's fever dropping from 104 to 101 is improvement. At this pace, the full year is tracking toward a $1.82 trillion deficit. The post-COVID spending baseline never came back down, and receipts haven't caught up to the new outlay floor. Nowhere is that more visible than interest costs. A decade ago, annual interest on the debt ran about $466 billion. This year it's projected at $1.39 trillion, up from $1.27 trillion in 2025 and $1.15 trillion in 2024. Interest costs have nearly tripled in 10 years, and that trajectory leads directly into the debt picture. The national debt stands at $39.6 trillion as of July 20th. That translates to roughly $118,000 per citizen and $264,000 per taxpayer, numbers that make the abstract visceral. The pace is accelerating. The most recent trillion, crossing $39 trillion, took just under 5 months, and each new milestone arrives faster than the last. At the current growth rate of about $95,000 per second, $50 trillion arrives by August 2029. Measured against the economy, debt to GDP sits at roughly 123%, well past the 100% threshold economists watch closely. A decade ago, that ratio was around 104%. Crossing 120% puts the U.S. in territory historically associated with fiscal stress, where investors start asking whether the growth needed to outpace borrowing is still realistic. There's been no reversal in sight. Who owns it? Private domestic investors hold the largest share at 68%, about $27 trillion, pension funds, mutual funds, households. Foreign investors hold $9.3 trillion, roughly 23%. Japan leads at $1.14 trillion, followed by the UK at $949 billion. China has been steadily reducing its holdings and now sits third at $659 billion, a quiet but meaningful shift in who finances American borrowing. Government trust funds hold $7.6 trillion, and the Federal Reserve about $4.7 trillion. Now, the average rate on marketable debt has climbed from about 2.9% 3 years ago to 3.4% today. That 50 basis point jump, applied to over $30 trillion in borrowings, is exactly how the annual interest tab now exceeds the entire defense budget. Here's the trap. Of that marketable debt, $7.4 trillion, about 24%, reprices within 12 months. Treasury bills and floating rate notes that roll over constantly. Every 25 basis point increase in rates adds about $19 billion in annual interest costs, and a full percentage point adds $74 billion. That goes straight to the deficit, which adds to the debt, which means more borrowing at the next rollover. The government has essentially financed itself with an adjustable rate mortgage. It worked beautifully when rates were near zero. Now that they're elevated, each rollover locks in higher costs, and the feedback loop feeds on itself. Week ahead. This is a blockbuster week for earnings, with some of the biggest names in the market reporting over the next several days. The headline event comes Wednesday, July 22, when Alphabet, tickers GOOG and GOOGL, and Tesla, ticker TSLA, both report. These are two of the most influential companies in the market, and their results will set the tone for the entire tech sector. Also reporting Wednesday is Texas Instruments, ticker TXN, which gives us a critical read on the semiconductor industry, plus ServiceNow, ticker Now, IBM, ticker IBM, CSX for a look at rail freight, and NextEra Energy, ticker NEE, the country's largest renewable power provider. Thursday brings Intel, ticker INTC, always closely watched for signs of a chip sector turnaround, along with Honeywell, ticker HUN, Thermo Fisher, ticker TMO, Blackstone, ticker BX, and Union Pacific. Friday wraps with Schlumberger, ticker SLB, American Express, ticker AXP, and Verizon, ticker VZ. Baker Hughes reports Sunday, and then Monday, July 27, brings Cadence Design Systems and Nucor, the steelmaker. Now let's talk about the economic data hitting next week. The high-impact release comes Monday, July 27, durable goods orders for June. The previous reading showed a sharp 4.5% decline, and economists are looking for a modest rebound of about 0.3%. Strip out transportation, and the forecast is 0.4% growth. That matters because aircraft orders can swing wildly and distort the headline. Also Monday, the Dallas Fed releases its manufacturing index. Earlier in the week, Thursday brings initial jobless claims, with an estimate near 212,000 versus the prior reading of 208,000. Friday is PMI Day, with S&P Global releasing its manufacturing, services, and composite flash readings for July, all expected to tick slightly higher. We also get June new home sales on Friday. And the CFTC publishes its weekly speculative positioning data Friday evening, covering the S&P 500, NASDAQ 100, crude oil, and gold. A useful read on where traders are placing their bets. On the IPO front, Scribe Therapeutics, ticker SCTX, plans to list on the NASDAQ Friday with shares priced between $13 and $15, a clinical stage biotech. And TP, formerly known as Teleperformance, is set to list on the NYSE Thursday. The digital services company was just named a leader in healthcare customer experience management by Everest Group. It's going to be a packed week. Between Alphabet and Tesla setting the AI narrative, durable goods telling us whether the manufacturing recovery is real, and positioning data revealing where the big money sits, there's plenty to digest. I'll be right here breaking it all down as the numbers land. That's your week ahead. As we near the end of the podcast, the key takeaways are simple. The economy looks resilient with unemployment at 4.2%, but leading indicators are softening while professional money piles into extreme positions across nearly every asset class. Watch Alphabet and Tesla earnings Wednesday. Their results will decide whether the AI trade still has legs. For interactive charts and all the numbers behind today's show, visit stockbeaver.com. Thanks for listening. I'll see you tomorrow.